think prices centered
Yeah,
around
we're gonna go
long
right
band.
to. Let's go
However, over
right
the
to
course
the
of the
Fed
last
talk
year,
here.
we've seen a
Jerome
growing
Powell is speaking. I'm
possibility
gonna go right
of a
to it. All
Fed
right.
engineered soft landing. And now it seems like everything has changed. In the course of a couple of months, JP Morgan has shifted to estimating the probability of a recession this year at around 60%. What do you think about all this?
Well, first of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago. So it's great to be back. And I would agree with you that it's been an eventful 7 years, putting it mildly. I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low fours, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that's where things were. Where we are now, again to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can.
Let's talk a little more about tariffs. I mean, you recognize that some of the effects of the tariffs will be one-off, transitory, but you also have said that perhaps they will give room for a number of firms to raise prices. You mentioned dryers. When washing machine prices went up because of tariffs, dryer prices also went up in tandem, even though they weren't tariffed. What's your sense about the effects of tariffs on inflation? What would make them more persistent, and what would make them have effects on growth?
So in a kind of a simple starting point is one tariff comes in that gets passed along in prices and raises inflation, but it's just a one-time thing. So the price level goes up, and that's it. But that can happen in some circumstances, but it depends on a number of things which we don't know yet. And I would point to a couple of them, or three of them actually. One is just the size of the effects. And as I mentioned, the tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. So that's one. The second one is how long does it take for the tariffs to have their effects on inflation? To the extent it takes longer and longer, that raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation. And the third is just what I mentioned in my speech, which is my remarks, which is got to keep inflation expectations well anchored. So if we have those three things under control, that's what it will take. And indeed, our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. That's a big part of our job.
What about the effects of tariffs on quantities? With the level of tariffs that, for example, have been currently applied on China, there's a fear that the supply chain may get disrupted, that firms may not be able to import their relevant stuff from China given the level of prices. If it turns into a supply shock, would the Fed's response be different than if it was primarily something which affected just prices?
So I actually had dinner at the Chicago Fed last night, and with a number of directors of various parts of the Chicago Fed, and many of them are CEOs of significant companies, and they this uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with if you look back at the pandemic, if you remember, there was a shortage of semiconductors, and that led to a shortage of cars at a time of extremely high car demand. And it was a prolonged shortage because production couldn't keep up. And that led to an extended period, one of the things that led to an extended period of inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and that can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that that process will take some years and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now, really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be.
Let's move to immigration. You talked about the labor markets being in reasonable equilibrium right now. Of course, what we've seen over the last few months, the last months of the previous administration continuing into this administration, is immigration has fallen off considerably. What's your sense on how that will affect the labor market?
So part of why growth was so strong in the last couple of years was just very high levels of immigration, and those people went to work. The economy hired them. You know, there was a lot of demand. We were still working off the labor shortage. What's happened since the prior administration changed their policy, as you mentioned, immigration has fallen very sharply, and therefore the growth of workers has really stopped. It's really stagnant. But at the same time, demand has also fallen. And so demand for workers, so payroll job creation has also fallen, and they've kind of fallen in tandem, which is why the unemployment rate has been pretty stable for about a year. So in a way, demand and coincidentally perhaps to some extent, demand and supply for workers has fallen. In terms of the effect on the labor market, right now we're still at full employment. And labor force participation is still strong. Wages have moved back down to levels that are now pretty sustainable, given an assumption about productivity. So the labor market's in a really good place. Longer term, you know, the effects of immigration are not thought to matter much for inflation. The effects on demand and supply will more or less cancel each other out. So we wouldn't expect there to be a big impact on inflation.
You've seen in recent weeks substantial talk about layoffs in government, as well as freezes in research establishments and universities in jobs. How soon and how big will this be in its impact on labor markets?
So it's too soon to say, but what I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be. Right now, it's not big enough to affect a workforce of 170 million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much that will total up to. And of course, in addition, cutting back on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things. But those are very difficult to estimate in real time.
Now, given that we're talking about the future, you may be confronted in the not so distant future with both higher levels of unemployment as well as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right. So most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension. And they're not really in tension now. The labor market is still strong. But the shock that we're experiencing, the impulses we're feeling are for higher unemployment and higher inflation. And our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll make what will no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks.
Just want to pick up on a word that is often used today, uncertainty. As a respondent to a Dallas Fed survey said, I've never felt more uncertainty about my business in my entire 40-plus years career. The worry today is not just about immediate policy uncertainty, but an entire change in the US's economic philosophy. Not just policy uncertainty, so to speak, but structural uncertainty. One of the effects, as you've pointed out, of higher levels of uncertainty is that firms postpone investment. For instance, even after the tariffs stabilize, firms that contemplate reshoring production facilities will hesitate, not knowing if the tariffs will be reversed in the future, maybe by the next administration. How do you take such longer-term uncertainty into account in your policies?
Let me just agree that what comes back very strongly, and everyone will understand this. These are very fundamental changes in, long held in some cases, policies in the United States, and there's not any real experience. I mean, the Smoot-Hawley tariffs were actually not this large, and they were 95 years ago, so there isn't a modern experience of how to think about this. And businesses and households are saying in surveys that they are experiencing incredibly high uncertainty. There's a lot of research, some of it from the Fed, showing that does lead to businesses and households stepping back from decisions, which of course makes common sense. And you hope that that's something that you go through a phase, and then you know what things become more certain, and therefore people can resume normal economic activities given their understanding of what is the new normal. I mean, your question really is, what if the uncertainty remains high? I think that's a difficult environment. I think people's expected rates of return would have to be higher. I think that would weigh on, to me, investment just in general. If the United States were to become a jurisdiction where risks are just structurally higher going forward, that would make us less attractive as a jurisdiction. We don't know that at this point, but I think that would be the effect.
Well, let me turn to financial markets. We've seen some volatility, especially stock market volatility. I mean, the levels of the VIX are up to the levels they were in the early days of the pandemic, coming off somewhat now. Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
So we've seen volatility also in the bond market. And at a time when usually there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on US Treasuries go up. What do you attribute this to?
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments, and with great uncertainty, and I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. I would just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
So the Fed, in its last meeting, slowed the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly. What if market disruptions emerge? Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close to the point, particularly close to the point where we would stop. But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General Account. For those of you who are Treasury market people, that'll make sense. But while those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the level of less abundant reserves. And so we decided to slow the pace. We thought about pausing, and instead we debated it. It's one of these great debates that we have at the FOMC. We decided to slow the pace instead. And people really came to see the merits of that because, the slower we go, the less, the smaller the balance sheet can get without disruptions. And we want that process to continue, and now it's at quite a slow pace. So we think that's a really good thing. So that means it can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still plenty of reserves.
What about the international dollar-based system? With all these disruptions, do you stand ready to supply dollars to central banks as you've done in the past when there's been a global shortage of dollars?
Sure, absolutely we do. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers. And we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then pay in their currency. They lend on in dollars, and so we take no credit risk or anything like that. And it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really good for U.S. consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency, most important, and we will do that.
You mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well, clearly, U.S. sovereign debt continues to rise. And what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt is on an unsustainable path. It's not at an unsustainable level, and no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment. And this is a situation that we very much need to address Sooner or later we'll have to, and sooner is better than later. In terms of, if I can say from my time working on these issues, it's not the Fed's issue, but if you look at a pie chart of federal spending, the biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. You know, neither party can figure out what to do without both parties being at the table. So that's critical. All of domestic discretionary spending, which is essentially where 100% of the conversation is small as a percentage of federal spending and is declining it's already declining as a percentage of federal spending. So when people are focusing on cutting domestic spending, they're not actually working on the problem. Domestic discretionary spending is already going down. I like to make that point because so much of the dialogue that the politicians offer is about domestic discretionary spending, which is not the issue.
Well, let's turn to stability and regulation. Turning to the U.S. financial sector, we still have some concerns about distressed commercial real estate loans on bank balance sheets, whether they've been fully dealt with so far. There's some sense that they haven't. Add to that the very rapid growth in various forms of private credit over the last few years, which arguably haven't been tested by a full-blown recession. How would you put the resilience of our financial institutions at this point and their ability to weather potentially uncertain times?
So I think our banking system is well capitalized with liquidity and is quite resilient right now to the kinds of shocks that it may face. I do believe that. In terms of the commercial real estate, there are, and this has been the case, really we've been working on this for 4 or 5 years now. There are some banks, it's mostly medium and small sized banks who have elevated concentrations of commercial real estate, some of it troubled, and we've been working to make sure that those banks have a plan, have capital, and can absorb the losses that they're doing. So, and that's been going on for some time. The very largest banks don't tend to have high concentrations, so this is a problem that we have known would take years to work through, but we're really well into the process of working through it. In terms of the non-bank financial sector, it's grown enormously. The provision of credit by non-banks has grown just really fast. Most of it has been funded, though, with a private equity-like structure where it's limited partners who are signed up for 10 years to a general partner to invest that money. They're not depositors who can run. You know, your money's committed. And so that funding model is kind of run-proof. That isn't some law of nature, though. So when you do start to see shorter term.
Honestly, everything that I'm hearing right now, and I'm sorry to cut in, but everything that I really am hearing right now is that we're fucked.
Quite large private credit part of the economy has not really been
Right?
through
Like that every fucking answer is like, well,
it's really grown.
it's not our problem. I think the answer
just
before
for that
that,
reason and for how
the
fast
question
it's
to the
growing,
answer
we
was,
have a close eye on it.
it's like
It
not the
doesn't have
Fed's
same kind
problem,
of
but
prudential
when looking
regulation,
at
though,
this,
that,
bro, it
that
sounds,
the banking
so he
system
is
has.
giving
We're
like,
watching it carefully. And, you know, as I
you
mentioned,
think we're
it's
at a
more
funeral right
stable
now?
funding source to the extent its institutional investors signed up for a
I
long
said
period.
this in
But we're watching
the
carefully.
chat, in the public
Right,
chat.
wearing my
Said
banking
his question
research
just
hat,
prior to
actually,
this
banks are
was
also
basically how
involved in
bad did
funding
Yellen
these
screw up?
institutions in a big way.
And Jerome Powell's answer is
We do know
essentially,
the administration
it's really
wants
bad,
to
but I
relax
can't say that.
regulations in
Like,
many
it's
areas, one of
essentially what it
which
is.
may well be banking. What can you tell us about the Basel III endgame, so to speak, which is, you know, at this point primarily focused on additional capital for the large banks?
You know, the Fed view, and my view, is that we should proceed to complete the Basel III accord, and we would have to do that, and would look forward to doing that in conjunction with the FDIC and the OCC.
I'm watching this and
But
it's
our
like
view
they
is,
have
and I
no
think
fucking
the
clue at
bank's
this
view
point
as
anymore.
well, is we should complete that. You need
They're
international minimum
covering their
standards. That's
asses.
kind of a common
And a
good.
lot of these
And,
question
you know, we're
setups
not
are
bound by them.
CYA,
Really,
remain neutral as
the United States has
possible,
plenty of input
divert,
into
divert.
what those accords contain. So our view is strongly that we should.
There's been some
complete
good
those, and we can
points
do
that
it, I
he's
think,
made, but
relatively quickly. We're
mixed
not
in
so
with a
very
whole
far
bunch
away
of
from from what would be a good, I think, outcome.
Let me be careful how I say
Well,
this
let
kind
me
of
move to
talk.
something which is more sort of about technological change and new kinds of instruments, cryptocurrencies. How do you see the potential for more favorable regulations coming on them and potential risks from that for the system?
So we went through a wave of failures and fraud and things like that were the headlines for a couple of years. And I think what you see now is, and during that period, by the way, we worked with Congress to try to get a framework, a legal framework for stable coins, which would have been a nice place to start. We were not successful. I think that the climate is changing and you're moving into sort of more mainstreaming of
Climate
that whole
change.
sector. So Congress is again looking at both the Senate and the House are looking at a framework, a legal framework for stable coins. Depending on what's in it, that's a good idea. We need that. There isn't one now. And stable coins are a digital product that could actually have fairly wide appeal and should contain consumer protections of the typical sorts and transparency. And that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters
SAB 121, anyone?
Appropriate innovation, but that does so in a way that again doesn't
muted
put
still.
consumers at risk in ways they don't understand or make banks less safe and sound.
You have a policy review underway. Now, surveys recently tell us there seems to be a distinction between a rise in the level of prices, which is what the public seems to worry a lot
this is all
about,
pre-scripted. You see how
and
the
the rate of
captions are
increase
out
in
before they even
prices,
talk?
which certainly they worry about in passing,
Yeah, I've been
but
watching
the Fed
it.
worries much more about. That is the rate of inflation.
It's
So
a little
even
weird,
though
a little
we're
odd.
coming down to 2%, people remember that over the last few years, it's been
lagging
over
down.
20% increase in prices.
No, but like
So as you start thinking
words,
about
the captions are
policy
there before they even
Is
speak.
there any thought about how you might want to address this
Yeah.
sort of challenge that it's the path of prices as much as the rate of change which matters?
First of all, I think you're right, and I think the public is right. When we say inflation is back down to 2%, 2.5%, and we think that's a good thing, it is a good thing. But if you're paying 20% more than you were paying in 2021, that doesn't help you much. You're still paying a lot more than you used to be paying for the necessities of life. So it's
lower
just
the
another way of
rates.
saying people hate inflation, and it's easy to understand why. All we can really control is a world in which, in the world we were living in, prices don't go down in the aggregate except in extreme times that we don't want to court. So I don't think we couldn't have a framework where we're going to bring prices down by 10% or something. That's not something we'll be looking at. We're essentially looking at the best way to foster 2% inflation over time. And the things we did back in, the changes we made in 2020 were really innovations around what to do when you're stuck near zero. Now we're well above zero, and it may be that we still need to have in our framework a way to deal with that, but perhaps the main case is not one where you're dealing with the effective lower bound, and that would be a framework that looks a lot more like the one that we had before 2020.
Now, one of the tools you brought in to deal with the zero lower bound was quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
QE.
In the beginning, it's typically we're using it for financial market function. That was the case with the global financial crisis and with the pandemic. And we did try to explain ourselves through the pandemic and our explanations did change, but I think it's fair to say we
Yeah,
might
they
have done
changed a
better
lot.
job of being clear about why
Right.
we were doing, and that's something that we're aware of and looking at.
I mean, no discussion is complete without talking about AI.
Yeah.
With AI coming fast and furious, it could affect productivity, it could affect employment. There are some people who say we will see for the first time technological unemployment in a serious way with AI. What are your thoughts about it, and how will it impact the Fed going forward?
So like everyone who's been exposed to what it's capable of, it's beyond, I mean, I started thinking about it as like a better version of Google, but it's not. It's like a better version of a person, you know? I mean, it can do amazing things, and so the question is, all through the 250 years of technological innovation, technology evolves and people worry that it's going to replace human labor and people will be unemployed, and that hasn't been the case. It may be the case in the short run, but in the long run, what it's done is raise human productivity and therefore living standards. So is this going to be the case where it eliminates more jobs than it creates? And we just don't know. I mean, you come back in 20 years, will it be the case that just people are much more productive in their work because of AI? Or will it be the case that AI has just replaced a lot of people? And I think it's very hard to say, but it truly is remarkable in what it's capable of. And it's, you know, we had a demonstration by a Wharton professor recently, and you speak to it like it's a person, and it kind of responds like a person. And the things that it can do are really amazing. By the way, this is early days. You know, they're talking about even the next couple of years will bring more dramatic breakthroughs. So I think it's one of the 2 or 3 things most likely to bring dramatic change to the economy all around the world in the next 20 years. And I'd say very hard to say how it shakes out.
Let me turn to your job. An important man once said of your job, it's the greatest job in government. You show up to office once a month and you say, let's see, flip a coin. And then everybody talks about you like you're a god. What is it that you normally do every day in the office? Is it fulfilling and, dare I say, enjoyable? And do you really feel like a god?
So I would agree. I think it's the best job in government. I would agree. I really do enjoy it. Yes, I love the job. It's a great honor to serve. It's quite humbling because, you know, everybody makes mistakes. It's just the economy is just not very predictable. All of that is true, and I do what everybody expects me to do. I read. We do a little more reading though as part of our daily. My colleagues and I do part of our daily regime than a typical executive would do. In terms of being a god, I would say that we are blessed with a large number of amply compensated critics who would kind of tend to undercut that. So we don't feel like a god.
So let me go to the more mundane. In that office, what are the key indicators you look for? What are the sources of data that you go to as you try and make up your mind?
So, you know, I'd say start with labor. You know, there's more labor market data and better reliable labor market data than probably anywhere else. And it's just a lot of data. And, you know, it's new jobs, it's payroll, it's wages, it's participation. You can break all of those down in different categories. It's a million different things. So there's a lot of labor market data. It's a great field if you're going into economics because there's just so much to do. So and then we look at the inflation data. Also, I keep track of global developments pretty carefully, and I talk to my global counterparts pretty regularly just to stay aware of what's going on. Financial markets are really important, and you know and lately something that we're paying close attention to, as you would expect, what's going on around the world in currency markets, in fixed income markets, in equity markets, all of that. For me, though, my background was more in the private sector, and you know, as an investor, and for a significant part of my career. And I have to talk to outsiders about what they're seeing and what they're dealing with for it to really kind of fit together for me. I can look at only so much data, and but to really get the story and the narrative, it's more talking to outsiders, and anecdotal data does help things kind of fit together for me, I would say.
Yeah, you told us about speaking with business people last night and getting a sense of what was going on in the Midwest. Let me turn to Fed independence. You've reiterated that you intend to stay in office until the end of your term, and that certainly reassured many in financial markets. What are the levers the government or the legislature have to pressure the Fed? And should one worry about threats to the Fed's independence once you're gone?
So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the Hill. So I think that's not a problem. There's a Supreme Court case people will have read probably in today's Journal at which the Supreme Court may decide whether independent agencies generally, whether their authorizing laws can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress where it really matters. And the point is, we can make our decisions, and we will only make our decisions based on our best thinking, based on our best analysis of the data about what is the way to achieve our dual mandate goals as we can to best serve the American people. That's the only thing we're ever going to do. We're never going to be influenced by any political pressure. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors.
All the liberals going crazy in the audience right now.
Well, I have time for one more question. I know the question that's on all your minds. What are you going to do on interest rates next? But I'm not sure that you know, and I'm not sure you would tell even if you knew. So I'm not going to ask that question. The question I want to ask is a more personal one. What is it that you'd like to do most at home after an exhausting day flipping coins in the office?
I play one of my guitars. I do Zoom calls with my kids and my grandkids, and I go to the gym.
I'm so
a lot,
happy.
too.
I'm so happy to know that he plays the guitar at home.
Thank you very much, Chair Powell.
Thank you.
And please join me.
Ladies and gentlemen, that was Jerome Powell, obviously the Fed chair, talking at the Economic Club of Chicago.
Economic Club of Chicago. Thank you, Chair Powell.
All right, we don't care
and
about
Dr.
what you got to
Rajan
say.
For such a wonderful conversation. You are a national treasure. And
National
I hope
treasure,
all of us
right.
can see how
National-
important
national
Chair
treasure.
Powell's role is in
I don't know where the fuck you see a national treasure. I need to turn you off. Can't stand you. Shut up. Anyway, welcome to the breakdown. I didn't even shout out anybody, but welcome to the breakdown, episode 548. Holy shit, approaching 600. Sponsored by Gemini. Trade $1,000 on Gemini, get $100 in Bitcoin. I don't know who would not want to get $100 in Bitcoin. A lot of you guys don't have a centralized exchange to call home. Sign up to Gemini. We've been partners for a very long time. Sign up, get that $100, man. And powered by the Gakshi News Network. Obviously, we streamed Jerome Powell here talking pre-scripted questions, in my opinion. Speculation, but it seemed like it was a little pre-scripted. You know, you had liberals in the goddamn, you had Democrats all in that crowd, no doubt about it, 100%. Especially on the second to last question, in terms of removing people from office or getting rid of the Fed. You know, everybody started cheering. Probably the 0.05% came into town to listen to the man speak. But right now, I got somebody here. I got somebody here to break down the markets with me, and that's Landy. Landy, what did you think about this? What did you think about this talk session here in Chicago?
Um, exactly what I was expecting based on, CPI data, PPI data, retail consumer spending coming out just today. So nothing too crazy. Look, the Fed is, and they kind of addressed this, or Powell kind of addressed this, is they're in a tricky spot, right? Because there is, as he mentioned over and over and over again, the uh, transitory, and he's using it properly this time, inflationary effects of tariffs mixed with, what we're seeing as right now a stronger labor market that could soften. But as it stands right now, we're in a place where, like, retail month over month sales just came out, and it's up. We have this weird mix, right, where we're seeing some deflationary aspects in CPI and PPI and the month over month. Yes, we're up on the year over year, but we saw a big surge in retail sales. This was driven primarily by a big uptick in. Let me go back, because I've actually been digging through the current report that's out, and we're up. Last month we saw increased consumer spending 1.4%. We're up 4.6%. So, what was one of the biggest drivers that kind of really stands out there? Motor vehicles. We had a big increase in furniture and home furniture, which is interesting to me because we were negative 0.7% last month to 7.7 this month. Electronics picked up by 1 percentage point. We have retail spending kind of fall off on the building materials side, fell off on the gas station side. Of course, energy costs are coming down, so sales on energy is coming down, and that was reflected in the primary driver of why PPI was under by 40 basis points just last week, right? So, what does this tell me? This tells me that because we're still in an environment where a lot of retail is taking on debt to buy, right? And they kind of went on a spending spree, and that's not very sustainable. So, we're in this kind of spot where we were. I think this is kind of a tricky spot to be in, because I don't think that it's sustainable on the retail spending side of things, which showed a lot of strength, but there's still, we're still living in negative savings rate environment. Delinquency rates are really high, and wages have been stagnant. And he did address this. Wages have been stagnant for a long time. So this is primarily credit driven. So it's debt driven. And what does that look like as there is the potential short term effect of inflationary pressures from tariffs, right? How much more deflation are we going to get in energy and staples, right? With some of the tariff stuff going on, I particularly want to see how agriculture AG responds because of the tariffs basically being levied. And you've mentioned this. It's almost like a blockade, a trade blockade, or I'm sorry, how did you term it?
Embargo.
Embargo. Thank you. So essentially, we have a lot of AG that goes over to China, and if that stays here at home, it's going to cause deflationary pressures, right? Which might create this environment where we're buffered on one side with deflation, but we have rising inflationary pressures on the other that are transitory. I actually agree with him on this. And then we kind of just have to reassess. I think we're not going to be able to get good metrics until May 13th PPI. And I prefer PPI over CPI. I know that, one is the underlying factor for the other that kind of aggregates everything, but I look to PPI in that. Um, ISM came up earlier, and that's kind of global, but I like to look at PPI. Which the more you say that, it sounds like you're just pissing in somebody's eye, but it, we're seeing mixed signals, and this puts the Fed in a very difficult spot, right? They have to kind of live up to their mandate, but they don't want to provide more inflationary pressures if there's already, some inflationary pressures in play, even if they're hypothetical at the current moment. They got to see the data. So I'd be looking to May for the data and see how we end out. What is it? GDP on the 30th? Is that what's coming in on the 30th? We'll see. It's going to be very interesting. I think they're in between a rock and a hard place, and I think that the bond market might be a driver there. If anything, I think they go for ending tightening. So they'll stop selling off their balance sheet and do balance sheet expansion instead of QE. What's the difference? One is a policy and one is not. It's a really mealy mouth way of saying that they'd be the buyer of last resort, push rates down. So we'll see.
To me, it's like, why don't they work with the Trump administration?
Well,
Especially the way he spoke today, There's a question asked about, are we in, is this debt, how far can we go until this debt really crushes, the United States of America? Why not get on the phone and actually, or get into the White House and work with Trump
it would be nice
and
to-
understand the plan that's happening?
I think that he wants to avoid the optics of being influenced by politics. I mean, he kind
But
of indicated
But
all
that
of this.
doesn't matter, Landy.
Yeah.
If you're saying that like this is unsustainable, right?
Yes.
At some point, if you're a smart individual, right? Forget about the optics of this shit. You want to save. You want to save the U.S. dollar, right? You want to save the economy. So
Mm.
you go in and you sit down with Trump and figure out what's your plan. What do I need to do? Look at the plan in general. How can we be more effective working with each other versus, waiting for him to come out once a month to fucking talk about the economy? Like if it's in that dire strait, right? Like if the way I was listening to this is like the US is fucked. That's all I was hearing as I was listening to this conversation.
Well, it was a lot of like, hey, the metrics aren't supporting of, this and that. And we're in a spot where we can kind of just sit on our hands, is essentially what he was saying at the end of the day, while also acknowledging that we're staring down the barrel of a gun. And in terms of financial crisis, in terms of debt crisis, in terms of the banking system itself. Look, he got put on the spot there on the Yellen thing because that was a veiled Yellen question and a short-term treasury yield question about the health of the banks and the repo and all of the rest of the stuff that gets me fired up and kind of leads back into maybe a little bit of your radio show this morning. But he he basically acknowledged but avoided throwing Yellen under the bus from the last 4 years, but he acknowledged what had occurred in the last 4 years that kind of puts us in this very, very tricky situation and puts them in a very tricky situation because I don't think that he told Yellen not to do what she was doing. They got into kind of a back and forth for a little while. And she kind of said, "Screw you, I'm going to do whatever I want," right? Which led to a lot of kicking the can with inflationary debt, right? That at the end of the day falls on the debt obligations to be met by the Treasury while we have this partnership with the Fed, right? So this kind of lock and key mechanism it seems to be falling apart between Treasury and the Fed in terms of working together to achieve the Fed's mandate versus the Treasury's mandate. And I'm wondering how this is going to play out kind of over the next month or two coming into the quarter because they indicated, he's already indicated, and I don't think he's going to switch stances on this. The Fed has indicated that they will likely do cuts end of Q2 into Q3. So we're looking at like June timeframe, right? That will, and of course they're going to mealy mouth their way all the way through, but I think next month is where we actually get a better idea of if they feel like they're going to act before then. Because if it's not next month, then there's no point, right?
So hold on. May go away, right?
Oh, the sell and May go away narratives.
Yeah.
That's only worked out in recent history.
Correct.
Even if you look at Bitcoin, it's kind of hit and miss. I think there was 9 to 6, 9 positive May closures to 6 negative closures, with recently having more negative closures in May. But it's a kind of an old market saying anyway. Kind of summer doldrums.
I've really put it on the line every single show that I have, whether it's on the radio show, whether it's this show. I've been saying that June will be a telling time for us to see where we head, especially to see if the Fed does any cuts.
I think the market's going to indicate before then.
My only thing is that they worked with the Biden administration, but it's almost like it feels like they refuse to work with the Trump administration.
Well, they worked with the Biden administration for a while until there was until we started to see some failed auctions, right? And then Yellen leaned on the Fed and the Fed said, go away. And then she was like, well, I have tools at my disposal too. And then there was that kind of a fight. Now, obviously that was in, spring to summer of last year. Yellen wanted to essentially kind of bolster things coming into the election. And Powell basically told her to sit on it and spin, right? Like it's pretty much what he said. And they stuck to their guidance. Yeah, they gave him a cut. They gave him, we got the 2 cuts, but it's not really. No, Yellen has tools. They have tools through the Treasury side of things, and
they fucked us up.
Yeah, they totally fucked us up. And
they
Powell didn't
to prop up fucking Biden.
Yeah, well, here's the thing. Powell didn't necessarily throw an assist, but he stopped being critical. He stopped, he has been vaguely, not directly critical, but vaguely critical.
Extremely critical of Trump.
Yeah, but he's not doing it directly. He's doing it indirectly through, market talk.
I'm just saying, look at here. Like we don't know. We can't size up. We got to wait until it's, bro, he knows. The one thing he did say is like, we can't compare it to the 1930s when we went ahead and put out tariffs and shit. Like, I'll give him, like, he's playing both sides of the fence and shit.
Of course. He was doing the same.
Like, bro, you worked with the fucking Biden administration and like, you're like, yo, I'm just going to keep my distance here. My thing is like, there's so much politics at play here, which is ridiculous, Landy. It is completely fucking ridiculous. We got to save an economy. We got to save the dollar and all this shit. And yet we're playing fucking politics. And you know what? We have the brains to do so. Yeah, this is a tough situation, but like we have the brains to kind of get us out of the situation. And you know what? If it calls for a year to 2 years of struggle, I hate to say this, man. I hate to say this because then people will be like, yo, like, but you're not in that position. But like, we need to do something in order, correct this course, man.
I obviously agree as a Bitcoin first person who wants to end the Fed. and make them compete again. That would be it, you know, but it still doesn't, none of that fixes what's happening right now and the path that things are on that, um, Trump is getting all of the and has gotten all of the hate for wanting to shake up the status quo. And what that does is it moves everybody around the chessboard, right? Um, Even though many other politicians have spoken, they've never really enacted. Even going back to last year, last May 14th of 2024, Biden put on a bunch of tariffs on China directly, right? And across various sectors, some were scaled, some were very high. Some were going to, start out at 25% and ramp up to 50 over the course of 2025 and 2026. Either way, that's when the fight actually began between the Treasury and the Fed. Post Chips Act, essentially we were going to reinvest, right? Take tax dollars, reinvest in all the chip manufacturers, right? And then tariff it right back. Well, what does that do? That's all inflationary. Why did we never hear Powell talk about any of that stuff? Why wasn't tariff the narrative? Because they had media cover the entire time telling us that we weren't in a bear market, we weren't in a recession, which technically speaking, we didn't go into a recession. Why didn't we go into a recession? Because there was so much taxpayer dollars being injected into the economy and so much government hiring that it avoided a technical recession, even though we went into a pretty prolonged bear market, 2022 all the way through coming into 23, right? What was it, like just over a year to even find the lows in traditional markets and crypto assets. So the narrative in the media combativeness wasn't there to make Powell talk about the tariffs last time. But Yellen and him were fighting over basically liquidity, right? Because they wanted a looser liquidity environment. He wouldn't give it to them. And he stalled them out all the way until summer when she finally broke, after a couple failed auctions, and was like, okay, like we're gonna just go we're gonna hyper we're gonna go the real short term end and really get these higher yield, the higher interest rates out there on the short end, and because they were failing auctions on the long end for a little while and the short end, and she wanted him to cut. And this is, there's that's what led to a lot of bloat in the bond side of things on the corporate and treasury side of things anyway, buoying that up. And of course, the Fed drawing down from the balance sheet. Once they're out of powder, right? The only thing to do is reload the balance sheet either through balance sheet expansion, which is just a nice way of saying soft QE, or making it a policy of QE, because there is a distinction between the two, of actually going in and actively participating in buying versus passively. And he didn't want to give them any room. And I think that was, I don't know, maybe it was to save face. Maybe he, all it did is contribute to a pretty large levered liquidity bubble in traditional markets. None of that came back in and helped anybody, in the quote unquote middle class or poor people. It just helped everyone. It helped the rich get richer, and the financial sector continued to bloat itself up that we just saw get, in my opinion, washed.
Welcome to the breakdown, episode 548, sponsored by Gemini, the good folks at Gemini, America's exchange. Yo, Gemini's been coming out with some really good marketing material, some really good content. Shout out to the marketing team. They're doing their thing, man. I was watching some of them. She looks like the last one looked like a Mission Impossible type of ordeal. I like where that's going. Obviously, Gokhshtein News Network runs all these programs. Shout out to all the media personalities that come join us. Landy's like a correspondent. Like, comes on here all the time to go ahead and break down all the shit that is happening in the markets. Yeah, I got to tell you though, I was falling asleep a little bit. Not with you, but when he was talking, I ain't gonna front, I was like dozing off a little bit.
Yeah, it was
Because
kind
it's
of
like
repetitive.
there's nothing new that's being said, and you know what I hate? I hate when like I hate when people don't give a solution to the problem, right? So like, you know how people are so like quick to point out like, oh, this is broken, right? But okay, so what's the solution? How do you fix it? And they never have an answer. He
We
might
have
have
to
an
wait and
answer, but
see,
he's not
David.
giving it out. So what the fuck am I listening to?
Here's the solution, David. We have to wait and see. We have a lot of tools at our disposal, and we have to see how the metrics kind of shake out over time in response to policy. And we are aware of these factors over here and these factors over here, and the ongoing trends, and the barrel of the gun that we're staring down right now. But that's kind of where our stance is. Our stance is basically mealy mouth neutral, and we are not going to give you an actual answer for what you would like to this problem.
So I mean, a lot of people when they say eliminate the Fed, they have some points because like they're supposed to be working. They're supposed to be helping us. Helping us. I don't think they've helped us.
Well,
I don't really think they've
David,
ever tried to help us.
hold on. Let me go here and just remind everyone that the Federal Reserve Act, including its amendments in 77 and 78, this was it was foundational legislation. And this act was to create oversight of the banking system so that things wouldn't get out of control. It definitely wasn't to create a large conglomerate that basically disallowed any competition or anything like that.
I don't give a fuck about the banks.
Me neither. We have vectors for being our own banks these days. If you end the Fed, I think I said this to you, right? I don't know if it was here or on your radio
I
show,
think
but
I think it was here when we talked about um when I asked you the question about who it, is it better? Wait, I forgot what I asked. I have to replay the tapes. I think I asked you, is it good to have a middleman, or like, do we trust that the government can actually control? You know, would you trust the government taking control of this shit? And it was
well,
kind of a back and forth conversation. Like for me personally, like you have to have some sort of system in place where, like, you imagine like who knows? In 2028, a Democrat might be elected. I'm not saying that'll happen, but if a Democrat gets elected and they get control, what happens? And I'm talking about gets control of, you know, acting as the Fed. What happens?
yeah. Well,
All
I
they
mean,
do is fucking look at the Democrats. I mean, like, I know people are gonna come at me and say that the Republicans do it too, and they're both. Let me say this: everybody's guilty from that standpoint.
well,
But
here's my
The
issue with.
Democrats keep on printing though. Like it seems like they print more than the Republicans.
Of course, they'd be kneecapped if there wasn't a public-private partnership, right? And the Fed being a private organization with that essentially, set up by Congress, and
But you know, like nobody
having
knows that,
oversight
right?
means what's that?
You know, a lot of people don't know that, right?
No, they think a lot of people think that the Fed is a government organization, but it's a
Correct.
public-private partnership overseen by Congress. And in 70, what was it? Between 77 and 78 is when we gave them the mandate, right? And that mandate, clarified their dual mandate of the stable pricing and max employment, right? And then of course outlining the metrics, right, for that. But one of the things that enabled was it enabled Congress and government to go wild because then there's no competition.
Yeah.
There's no because it's a public-private partnership where you've picked winners. And instead, if you end the Fed, banks have to compete again. And now we're in an environment where we have crypto systems and decentralized finance that could compete, not currently in terms of size, but can compete in terms of product in that same space. And now, the race has been on for these larger players to gobble up as much as they can so that they can control, the actual DeFi ecosystems, even though
They
it's
would have
still decentralized.
they would have loved to have a Democrat like Kamala Harris in office
Sure.
to continue the policies that were in place 4 years ago, to have the people in place like they had 4 years ago, so they could have taken full control of crypto. Because it wasn't ever about destroying crypto, it was about
Hell yeah.
controlling it.
Preach.
And
Preach.
and everybody, every single conversation I have, whether I go on to, spaces, I go onto a podcast, I talk here nonstop. People have this perception that the government was looking to destroy. No, the government was looking to help their friends, the people that pay them money. Okay, from all these PACs, they were looking to help them. Just like I believe Gary did everything possible to help his boys on Wall Street, everybody else was trying to do the same exact shit. So like this whole killing of crypto, killing Bitcoin, that was always nonsense. That's mainstream media feeding you the garbage that you continue to ingest every single day. You guys refuse to go to independent media outlets to get information that is unbiased. Some will say that, hey, independent news organizations can be biased, but no, like if you look, for the most part, we take the information and we throw it out there, and then you formulate your own opinion. You can see this from a mile away, man. They thought crypto was a joke. Every single at the beginning, I really do believe that all these banks, all these institutions, all these major players, Wall Street included, believed that fucking crypto was a complete and utter joke. They didn't take this seriously. They didn't take any of this seriously. Look at the man who bought another, what was it, $13 million or $13 billion worth of Bitcoin today? BlackRock, Larry Fint. I think it was 13 million or billion. I'll get that clarified.
Million. If it
Million?
was
They
billion,
bought
we
13
would have seen
million.
a nice reclaim in the range above. The
13
the
million.
yeah,
What do you think? They weren't buying this shit even when they were going out there and just putting fucking Bitcoin down and the rest of this space?
okay, so I have to kind of address this because this is kind of my wheelhouse, especially when considering some of where I come from. They weren't buying. They were definitely fudding to then get the
No, but
initial
hold on, hold
investment
on.
into
Before
fund.
you say, I'm not talking about BlackRock buying. I'm talking about personally
Oh,
these
personally,
people
sure.
buying. I'm
I'm
not.
sure that they've been positioned for a
Yeah,
while.
yeah. Jamie Dimon has Bitcoin, and nobody's gonna tell me otherwise.
The
I'm not
moves
talking.
that they're
Forget about
making would
Chase.
indicate that. Yes, the moves that he has made would indicate that he is a Bitcoin bull at the very
You don't
minimum.
sign out. You don't sign off on an ETF. Like J.P. Morgan signed off on an ETF. Like you don't do that. Those kind of things.
No, but this is kind of gets to the core of what I believe. What you were just saying is they would have loved to have a Kamala administration to continue the policies against crypto because it essentially allows them to utilize other people's money via assets under management to buy all of these assets, repackage them, and sell them right back to everyone because they have access to all of the portfolios. They can just send out like, "Hey, this is the allocation that we feel is going to be the future projected allocation. Here's the framework and the risk framework within with that we would provide in terms of guidance. Go have fun with all of the portfolios that you manage." Right, and then we're still seeing that, but I think that was always the plan, and I think that plan shifted dramatically in 2020, and it accelerated for them. And I will, I've pointed this out a few times, but I always look back to exchange reserve balances for Bitcoin in particular. Exchange reserve balances were rising all the way in an uptrend all the way until March of 2020. They went into their first exchange balance reserves for Bitcoin went into its first long-term downtrend. Throughout 2021 into 2022, it was sideways and down. And then we had a massive drop off late 22 into 23 for exchange reserve balances. And then what did we hear throughout 2023 and 2024? All the rumors about wrapped products, spot ETFs, bigger players trying to get positioned, ideas changing about, oh, well, we're more receptive to crypto now. And then, of course, we saw the launch of those wrap products. Exchange reserve balances went into a parabolic downtrend. And I don't see it ever recovering back into an uptrend, right? So when did they really shift? They shifted in 2020, and that's bigger players. You don't see, Bitcoin at, exchange reserve balances over 3.1 to 3.2 mil drop all the way down to, 2.9, which is a massive decrease in exchange balances, unless you've got big, big, big players that are like, hey, we need to get in on this now. You just don't. And I think that that's going to be the path that we see for crypto in general. Is just buy it, repackage it, resell it. That's what they wanted to do, but they wanted to have the mandate over that. Cut
You know, I've
everybody
always
else
been
out. You're going to buy it from us.
I've always been loud about how much I hate derivatives and the products that they're going to push out there to the general public for Bitcoin. I've always been loud and vocal about that. I think
Well,
I just feel I don't trust Wall Street and I don't trust these institutions at all. Everybody's happy, and I understand why everybody's happy. Everybody has bags, and everybody's waiting for all this money that's on the sidelines to come in. So bags go up, people become multimillionaires. I get it, but the long term health of Bitcoin and yeah, I say that Bitcoin too, Bitcoin and every other cryptocurrency, you know, has to come into play. You know, BlackRock can wake up one day, and I know we can go ahead and battle back and forth and say like, look, we have the ability to shut them down if they ever attempted to go ahead and do any sort of fuckery, but still, you can't trust any of these motherfuckers.
no. And the play was always to prevent competing financial systems that compete with traditional market systems and the traditional banking system. So don't compete, take it over, cut everybody else out. I mean, even look at the policy stance that they took up near the end of the Biden administration versus DeFi.
Yeah.
It's all in an effort to squash competition and
Sam
hold the
Bankman-Fried.
reins. Yeah. SPF,
Sam
all of it.
Bankman-Fried. Why doesn't nobody ever talk about the bills that he was trying to pass with the rest of the liberals? Excuse me, the Democrats.
He was a plant.
But
It's obvious.
but nobody acknowledges it.
Well, I mean, hindsight 2020 for many people, they just don't want to admit they were wrong.
Admit that you're wrong, because you know what happens? We get to look out for the next plant that comes in here. If you think they're not glowing up somebody to come into this space in the next few months, you're crazy. They have somebody, they're preparing somebody to come in here and to, push their agenda out here. Watch.
Of course.
I'm not going to mention Murad's name.
Yes, the liquidity washing machine that was the Murad meme coin list.
Keep
Look,
clicking, right? Keep clicking.
hey, the only thing if there is things that you can click on, there's a lot of like really cool like test nets that you can get airdrops from just by clicking, but that's about it. Unless
People
you
lose
actually are
so much
sophisticated.
money. People are losing so much money. Free airdrops. Like I can't, honestly, people have made multi-million dollars by just getting airdrops.
Yes, and faucets and all kinds of stuff. That stuff still happens. No one pays attention to it, but that's the kind of clicking that I care about. Obviously, I'm in meme coins and all the rest, but when it comes to like kind of what we're witnessing and kind of the change of guard, especially with the crypto positive talk out of the administration, we need to see some action, right? Some policy action, and it's baking in the background, but we're in a weird spot where traditional systems have to now run up against and try to adjust from their plans that they were putting together under the previous administration and how they're going to approach crypto and handle it. And I think that the only way forward, in my opinion, long term, is you and the Fed make them compete, and that keeps that keeps Congress and the Treasury honest. Why? Because they can't just go and borrow, spend, spend, spend. They have to find a vector for that, and then you now have competition that can hedge against that in the open market instead of having this big giant system that is realistically accountable only in like, hey, our metrics are this when they're dragged in front of Congress. You're muted. David, you're muted.
I'm muted. Great. I was about to say, I appreciate you for coming on. I appreciate everybody for tuning in. It's a minute away from 3 p.m. Eastern Standard Time. Show started a little bit later just because I was on a very important meeting. Knock on wood. And I appreciate Landy for reminding me about Powell speaking today. So we streamed it. We've talked about it. I'm sure there'll be more discussions tomorrow in the morning at 9:30 a.m. Eastern Standard Time. I think I want to go into this topic and talk about it a little bit more. Congratulations to you. Shout out to, what was that guy's name? Buzz? I think that
Buzz?
guy's name. Buzz?
Buzz
That
is
you
smart.
and him. No, I actually enjoyed the banter, going back and forth. There was nothing to me that seemed childish about it. It was just back and forth, questions here, answer it here. I like that. I like a good old fashioned debate. So shout out to everybody that, it's funny. I can repeat this because it's somebody said, they're like, I remember coming in here in like 2016, 17. I remember all the people that were here, right? All the people that had pull and all this stuff, and they were out here. And now you look at 2025, only like, 5% of that 100 remain here. And, it was said to me, it was said that I'm one of them. And I laughed because I thought for a second, holy fuck. I remember how many really, there was a time where people were really getting engagement. They were out here, they were TAing, they were putting up winning charts all the time. And they're no longer here. I've seen one or two try to come back and they have no push at all because people don't know who the fuck they are. So it says a lot about people like you and others that have grinded through bear markets, through bull markets to provide information to the general public. And that is something to go ahead and clap about. Yeah, fake charts. We caught Moon Call out there, paper trading, acting like it was real money. Well, I won't speak about that.
Well, I want to
go
say
ahead.
thank you for facilitating these kinds of conversations. And of course, thank you for having me on with you today. It's fun. I like talking about this stuff. And I didn't want to get into like maintenance margins and repos and like all that kind of stuff. You want to talk about people falling asleep, right? It would have been a Jay Powell kind of a scenario between him and I after a while if we went that deep.
But that's what the space is missing. So like, yeah, you can go and visit shows that are talking about, things in layman's terms, but you also have to have shows that, allow you to understand how markets work, right? And if you need a dictionary or you need to use ChatGPT to understand what the fuck is being said, then that needs to happen. Like, you need to understand how all this shit works. Otherwise, you're fucked. Like, I'm telling, like, a lot of people are getting lucky on their plays. A lot of people are just getting lucky on their plays. What happens when we go into the next cycle where the institutions, I fully believe the institutions and big boys are running the shit?
Mm-hmm.
How are you going to be able to go ahead and navigate that shit?
It's tough. It's tough. These kinds of conversations, and why I say thank you for providing so many different people a platform to speak on some of this stuff, is because they aren't being had anymore, because we went through kind of like they weren't being had during the NFT craze last cycle. All the fundamental conversations, underlying economic conversations, they go away in these time periods, and then we round back to them as fears rise for bearishness, right? Then these conversations start to be had again, or when it's hyper bullish and it catches people off guard, like, what did I miss? And it's like, oh well, hey, we've been talking about this over here in this little corner for a long time, but it's no one's really paying attention because it's rote. There's money to be made, or people believe there's money to be made because they're excited or they're scared. So it's the ebb and flow. I enjoy it. Tammy and I were in DMs, kind of going back and forth about some stuff that was actually really fun. Um, because we were generally in agreement on just about everything that was talked about, but we were kind of going back and forth, and I think these conversations need to come back, David.
We shall bring them back. And I appreciate you. I appreciate everybody who tunes in. I appreciate everybody who supports this show. Thank you very much. Thank you, thank you, thank you. I already gave you the lineup of shows that are out there that you can tune into. Appreciate everybody. Again, I always say this fucking word, but I really do. I really do appreciate everybody. Again, you can replay this show. Powell talked today in Chicago about whether he's going to cut rates, which he really didn't elaborate on, but he talked about everything about U.S. good old A. Show is sponsored by Gemini, America's exchange. Click on the link, trade $1,000 in crypto, get $100 in Bitcoin. Who wouldn't want $100 in Bitcoin? This show is powered by the Gakshi News Network. Stay tuned. We got more fun shit coming. And this has been The Breakdown. This show, me and Akil started this a long time ago, and it was like an everything show where we would talk politics and we would rip on each other, and it's turned into this. Unofficially, over 1,000. Officially, it's at 548. We are moving closer to 600. So that's pretty cool. I didn't think that my potty mouth would allow this show to go ahead and last. Tomorrow, I promise, I'll come back. Obviously today's meeting, we sat back here and we watched that. But tomorrow I'll come back with the building of the multi-million dollar portfolio. Okay. Maybe we'll have people chime in. Maybe I'll bring on people to chime in on it. But as I stated yesterday, you can replay yesterday's show. Right now, in no order, it's Pepe, Bobo, Augie, Mog, Hoppy, Doge, Brett, Fartcoin, Giga on ETH, and Solana on Ethereum. So, but there's more. There'll be more. So relax. I know there's a lot of communities waiting. Okay. I know right now I just got a message, and I will talk about it. Okay. Because I think that one actually, Landy, is really the top dog when it comes to Bitcoin. But on that note, I want to thank everybody. Thank you, Landy. Thank everybody. See, I flow. My flow's sick, man.
That's good. Thanks, David.
Yeah. I appreciate everybody. I hope you guys have a wonderful day. Tune into shows, study crypto, get your money. I'm out.